So now we'll come to the next topic under financial management, that is financial decisions. This is the third part of financial decisions, that is dividend decisions. First we'll discuss that what dividend is. Dividend is basically that amount of profit which is distributed among its shareholders. Shareholders, they invest some money in a company, and in accord to that investment, a company provides a certain amount to the shareholders as dividend or a part of profit. So under dividend decisions, right, generally there are two major kind of decisions we take. First one is that what amount of profit should be kept as retained earnings, right, which would be further utilized by the company for the investment purpose, right. And the second one is the amount of profit which is to be used as dividend, which we are going to provide to our shareholders. So generally two kind of decisions are there: retained earnings, amount of retained earnings, plus the amount of dividend we have to provide out of its profits. So that is the dividend decisions. Now let's start with the next topic, that is factors affecting dividend decisions. First factor which affects any decision which a company takes related to dividend, right? The first one is amount of earnings. Dividend is, as I told you, that dividend is a part of profit which is distributed among its shareholders, fine. So if a company is having good earnings, high earnings, right, it would be able to pay high dividend. Dividend is generally paid out of current and accumulated earnings, fine. So a company which is having high current earnings plus the high past earnings, right, so that company will be able to pay higher amount of dividend to its shareholders. So more earnings, more dividend, simple. Second is stability of earnings. If a company is having stable and regular earnings or profits, you can say, that company would be able to pay higher dividend to its shareholders, since that company is stable in terms of earning profits, fine. So that's why they are able to pay higher amount of dividend to its shareholders, whereas the company which are not stable, unstable, and are not having a regular amount of profit or earnings, they won't be able to pay higher amount of dividend or any kind of dividend to its shareholders, and thereby shareholders, they will remain, unsatisfied or dissatisfied. Third point is stability of dividends. In the previous point we discussed about the stability of earnings, whereas now we'll discuss about the stability of dividends. There are certain companies which tend to give stable amount of dividend to its shareholders. Why? Because if a company provides stable amount of dividend, right, each year to its shareholders, that eventually increases the goodwill of the company. If the shareholders, they are investing any amount in any company, then they expect some profit out of that investment. So obviously if a company is able to provide them fixed amount of dividend or stable amount of dividend, that provides a kind of trust among the shareholders, and they start trusting the company in terms of the profit, and that eventually increases the reputation or goodwill of the company, fine. Fourth one is the growth opportunities. There are types of companies which have a focus towards growth, or which you can say companies which are growth oriented, whereas there are few companies which are not growth oriented, but they just believe to stabilize in the market, just to make or sustain their current position in the market. So they have different kind of focus. The company which is growth focused or which is growth oriented, you can say, such companies, they prefer to retain more amount of profit as retained earnings, and what they do, they have higher amount they keep as retained earnings, whereas the lower amount they keep as dividend. Or as I told you that in dividend decisions, what do we do generally? We decided what amount we have to keep as retained earnings, fine, that would be further utilized as for the investment purpose, fine, and some amount will be distributed among its shareholders as dividend. So the companies which have growth opportunities, they generally prefer not to pay dividend or to pay less amount of dividend to its shareholders and keep higher rate of profit or higher proportion of profit as retained earnings, because further they have to invest in the growth, or you can say that they use that retained earnings for the investment purpose, maybe for buying any kind of machinery or for buying any kind of building. So they are expanding their business, or for the expansion purpose they use those retained earnings instead of paying higher amount of dividend or any kind of amount to its shareholders, dividend to its shareholders. Fine. Next one is the cash flow position. Cash flow position means that the money is going out, right? Money is going. Dividend, if we are paying dividend to our shareholders, that indicates that cash is flowing out, fine. That is outflow of cash, or the cash is flowing out. So if dividend which a company pay, or the ability to pay dividend, it is actually decided by or depends on the cash position of company. Sometimes it is possible that a company is earning profits, but the same has been invested in assets, right? There is a company which is having higher amount of profit, but that particular profit, the part of profit, is not utilized or used for paying dividend, but that is being utilized for buying assets. Means the cash is flowing out, but in some other direction. Means that company is using that amount for buying assets like building, furniture, machinery, any kind of asset. The money is flowing out, but for buying assets, fine. So if a company is investing more in buying assets, that company will not be able to pay dividend, or that will reduce the ability of a company to pay dividend, fine. Next is shareholders preference. Before giving any dividend, or before deciding what amount of dividend is to be given, or any decision which a company has to take in terms of dividend, that company look at the preference of the shareholders, fine. If the shareholders, they prefer that a company should provide them a regular amount of dividend, stable amount of dividend as a regular income, then a company will follow their preference, fine, or they will provide them a fixed amount of dividend. So before deciding upon any decision or taking any kind of decision related to dividend, first a company tries to see that what their shareholders prefer, fine. Next is taxation policy. Generally the dividends or dividend is paid out of after tax profit. So we have to see that a company earns profit, out of that profit tax will be paid, fine. For the tax will be paid, then the remaining amount, then out of the remaining amount of profit, amount of profit which is there after paying tax, fine, out of that amount the company will pay dividend. So that is the meaning that dividend is paid out of after tax profit, fine. So in that case, what happens if the tax on profit, right, it is higher, so less amount of profit will be available as the amount which we have to pay as dividend. So if there are higher amount of or higher rate of taxes there, then the company will prefer to pay less amount of dividend. Whereas if there is less, or you can say the lower rate of tax, fine, then in that case a company will be able to pay higher amount of dividend, fine. So rate of tax and the amount of dividend, they are actually, you can say inversely related, that high rate of tax, fine, that will lead to lower dividend, or if less or a lower rate of tax will lead to higher dividend paid. So that they are inversely related, fine. Next is stock market reaction. Now the rate of dividend is directly related to the market value. If any company is having or is able to pay higher amount of dividend or stable amount of dividend, regular amount of dividend, then that particular company is going to have high goodwill or high market value or high market share, fine. So higher rate of dividend, if any company is paying higher rate of dividend, then that particular company will have a positive impact on market prices of shares. If any company is giving or paying higher rate of dividend, then eventually automatically that particular company share in the market are going to rise. Ninth is access to capital market, fine. Capital market basically provides funds to the companies, right? So any company which is financially strong or which is large in size, such companies, they have easy access to the capital market, right? Such companies are able to get a fund from the capital market because of their position, fine, financial position. Such companies, they are easily access to the capital market, so such companies, they don't have to be dependent on the retained earnings for any kind of investment, fine. So in that case, such companies, they will not keep higher amount of profit as retained earnings. Instead, they will provide high rate of dividend to their shareholders, right? Instead of keeping more amount as retained earnings, what they'll do, they'll provide more dividend to their shareholders, so that their market share or their value in the market, their goodwill, it should increase, and their shareholders, they should get maximum satisfaction, and eventually what they'll do, they'll invest more and more in their company, fine. So financial position of a company, higher rate of dividend leads to high market share, high goodwill of a company, you can say. So these things they all are correlated. Next is legal constraints. According to the provision of Companies Act 2013, first, any company has to provide depreciation on fixed assets. Suppose there is an amount of profit, out of that amount of profit, first a company has to provide depreciation on fixed asset. Then there are some more provisions that a company has compulsorily maintain debenture redemption reserve, that is DRR, fine. It has to be compulsorily maintained, which is maintained out of profit, fine. Other provisions, they say that any company depends on the financial position or the capital of any company has to provide 2% of profit as CSR. CSR is what? It is corporate social responsibility. So they have to use 2% of their profit as for the CSR activities. For the for such activities, the company has to use 2% of the profit. Next is contractual constraints. While providing loans, any bank or financial institution, they impose certain restrictions or constraints on the payment of dividend to any company, right? So before giving any kind of dividend, a company has to follow, or they have to pay dividend, they have to follow such restrictions and constraints. So the company, while providing dividend, the company cannot violate such restrictions which were imposed by any bank or any financial institution. They have to strictly follow such restrictions and constraints, fine.